Management Accounting Part 12 Special Orders. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email and our phone number. This is an extension of some of the topics that were discussed in Management Accounting 9, which was about special orders. I want to go back and talk about incremental cost and revenue as it relates to this topic. First of all, relevant costs. The definition of relevant costs are costs that change when considering different decisions. I'll refer you to Management Accounting 8 for that discussion. Relevant means meaningful. Relevant answers the so what question. Relevance means yes, this amount, this decision is important. Incremental cost or revenue relates to special orders. We only get incremental costs or revenue when we're considering taking on new business. So if circumstances change and we're going to take on new business, particularly business that we weren't planning on, we only look at the revenue and new costs going forward. We don't consider sunk costs, which we've discussed several times. Sunk costs being those costs that we've already spent, we've already incurred the cost, and we can't get back. Let's look at an example of special orders, and I want to set up my example with an article from the Wall Street Journal, Hard to Count the Cost, which deals with pricing psychology. And they use the example of Skippy Peanut Butter, and I'm quoting here, Skippy Peanut Butter recently added an indentation into its jars that reduced the size of the jar by 9% while keeping the price the same. They go on to say that consumers tend to react less to this subtle price inflation than to a higher price tag. So simply put, if the container you're buying the product in is smaller and you keep the price the same, people are less likely to notice than if you keep the container the same and increase the price. But there's a question here for Skippy, and the question is manufacturing the new jar with the indentation more expensive? Sounds like it might be. So what I've done is created an example with the Perfection Jar Company that makes jars for Skippy Peanut Butter. And here's how things look for Perfection before they get the special order. They sell 1 million jars at $1 a unit. We've got direct material, direct labor, direct materials, incurring overhead costs, selling and administration expenses. So for that $1 sale, they incur 90 cents in expenses, and they have an operating income of a dime for every $1 that they sell. Then they get a call from Skippy. Skippy Peanut Butter approaches Perfection Jar with a special order. We Skippy want you, Perfection, to make the jar with the indentation on the side, the indented jar. What's important to realize is that if you're Perfection Jar, your cost per unit for those indented jars is not 90 cents up here for this particular order. And let's explain why. Let's assume you're going to sell 10,000 jars to Skippy Peanut Butter in this special order. We're going to sell them at 97 cents a jar. We're going to incur a little more direct labor from 35 to 37 cents because the variable cost is going to require a little more labor. We're going to say that the direct materials actually decline because the indented jar requires less material to make the jar. By definition, the jar is smaller. So we're going to incur these costs when we make the special order. If we didn't make the 10,000 jars, we wouldn't have more direct labor and direct material. But here's where we gain something. In our fixed costs, factory overhead and selling and administration, whether we make these 10,000 jars or not, we've already incurred these fixed costs. In my example, I've said, let's assume that the factory overhead increases by 2,000. The selling and administration increases by 1,000. Okay? What we already incurred for factory overhead, in this case the 110,000, is not relevant. That money's sunk, we've spent it either way. We're only worried about the increase for making the special order. For selling and administration, it increases by 1,000. That 220,000 that we've already spent before the special order is already gone. That money's gone. It is not relevant for this decision. So the 110,000 overhead and the 220,000 selling and administration that we've already incurred is not a part of the decision to make the special order. So as it turns out, when we add up all these expenses, you'll see that our sum formula here means that for the 10,000 jars, we incur $8,700 in expenses, $9,700 in revenue, and we have operating income of $1,000. And here's a critical point. You'll note that the price of the special order is 97 cents, where the price of our other sales is $1. So off the top of your head, you'd think, well, if I'm selling for less, it won't be profitable. But in fact it is, and the reason that it is that our fixed costs are much lower because incrementally our fixed costs don't go up for very much, and that's why we have a profit. I want to switch gears as we finish up and talk about pricing psychology that they mentioned that I thought was very interesting in the article. Psychology matters as much as logic in many simple economic decisions. When you're out at the grocery store making a decision on what you're going to buy, I always use the example of there are certain products that I'll buy generic, but there are other products where I want to buy a name brand. For example, I'm not going to buy my local supermarket's manufactured mustard. I'm going to buy mustard from a name brand company like Heinz because the quality of the mustard is important to me. One way that consumers can be fooled by pricing is if there's a new package and a new price, and suddenly you don't have a basis for comparing it to another product. Another way to influence buyers is what they call anchor products, high-priced items that consumers use as comparison points. And you can think about a restaurant. If there's a $100 serving caviar on the menu at a restaurant, and there are other entrees that are only $15 or $20, $15 or $20 will seem inexpensive. But if you took the caviar off the menu and you only have the $15 and $20 entrees, they may go from looking inexpensive compared to caviar to looking expensive when compared to other restaurants. So by putting high-priced items on the restaurant's list of items, other items on the menu that may be expensive in comparison with another restaurant may look cheap compared to the caviar. So it's all a matter of perception. And finally, I think it's part of human nature that we all overvalue certainty. Okay? I always buy the same things because I know what they taste like and I'm going to get the same results. So we overvalue certainty. The writer says that we put too much importance on the certainty of the products and services that we buy. In other words, we should be willing to experiment with other products, pay a little less, because the results won't necessarily be worse. So we're all risk aversion. So companies that are producing goods and services know that people like certainty and are willing to pay a little bit of a premium for the certainty. That's the end of Management 12. We have monthly small group live chats the first Saturday of the month that are inexpensive. Our YouTube channel is the second bullet point. You can register for individual tutoring and live chat over the web at our website. Here's our phone number and our email. Thanks very much, and we'll see you next time.